Howdy, Jacob here. Today we're looking at Pitney Bowes, ticker symbol PBI. So first thing, we have a $751 million market cap with a $2.3 billion enterprise value. A lot of net debt here. Return on invested capital, pretty low. Looks like since 2016, probably averaging low single digits. Current 4.69% dividend yield. Let's look at that balance sheet of that debt. Okay, so they're down quite a bit from 10 years ago. 3.6 billion in 2012 down to 2.2 billion in 2022. 670 million in cash and just 11 million in short-term investments. So just under 700 million in cash equivalents roughly, and then a little under 2.2 billion in long-term debt. That's a good amount of net debt, especially looking at maybe their 5-year average free cash flow. We're probably looking at, let's say, 100, 120 maybe. Let's go 150. So 150 million, 5-year average. That gets us to a payout that's pretty reasonable. So their payout of 35 million in comparison to 150 million is about high 20%, high 20% payout ratio. It's definitely reasonable, and it looks like they have been paying down debt every year outside of 2016, 2017. Their use of cash, it looks like recently they've actually made divestations rather than acquisitions. Use of cash is pretty heavily on paying down debt, paying out a dividend, and then maybe just a little bit on acquisition side, a little bit on share buybacks. Interesting company. So enterprise value is very high. Their payout is reasonable, and in the last at least 6 years, they've been focusing on paying down that debt, which is great to see. Let's let's start making some assumptions here. Let's look at 3.7 billion in 2013 to 3.5 billion now. I'm just going to assume no growth and 10 on the PE, price to free cash flow, with a 15% return. Margins have looked a bit lower recently. Let's look at gross margins and operating margins. 58% gross margin in 2013, all the way down to 32% in 2022. Really don't like to see that huge decrease. And then even worse, 18% operating margin down to 5% operating margin. Definitely not what you want to be seeing there. The Not a lot of growth with decreasing margins, a whole lot of debt. That's a tough business to really try to push. So let's see. Let's try average, but it has been going down. So maybe 2.5, 3.5. Let's assume no share changes. And then again, I said their payout is maybe 30%, but this is a company that's going to want to spend a majority of their cash paying down debt to make sure that their lenders are as comfortable as possible with, how much cash they have, their cash from operations, and then or their free cash flow, and then the debt they have on hand. So I think lenders are going to be really coming at their leverage ratio and want them to bring that down as much as possible. So to me, I'm definitely not increasing this dividend. I think the company itself looks fine. I mean, we're again, like I said, there's some negatives for the decreasing or slash flat revenue, decreasing margins, but again, every business that makes money has a price, and so would you rather buy this company that is going to hopefully pay down a lot of debt for, let's do a stupid, ridiculous example, a 2 PE on a 5-year average basis, or Apple at a 100 PE? I mean, it's not just the business you look at, everything is the price you pay for it. And so to me, I think it's an interesting business. The debt just initially is definitely giving me concern, but uh, a flat business can most definitely still be worth something. And so for me right now, just because that debt is as high as it is, just going to raise that a little bit. The discount rate to 16%. I usually do 15%, but the debt's a little bit more than I want. So before I look at anything and do more research, we're saying it needs to fall 38% before we get a 16% return, given the assumptions. But right now, I think I'm comfortable with these assumptions. I think it's a all right company to add to your list. Again, I think if you're looking for very stable dividend companies, I think this is somewhat stable, but it has way more debt than I'd be comfortable with. It has over 10 times their 5 year average free cash flow, since we said about 150 million 5 year average free cash flow, and they have 2.1 billion, 2.2 billion almost in long term debt. So until you know that their lending situation is very far in the future, nothing's coming up short that could hinder their ability to keep that debt as high as it is. I think what they're doing right now with their free cash flow is right. I just hope it's not too late. So, like I said, sub 30% payout ratio on dividends, maybe 60-70% going towards debt, and then the rest split between acquisitions and common stock buybacks. I think that's a fair thing to do, but um, I hope their debt situation isn't too late. So yeah, I hope everyone had a good watch and has a good rest of their day. Thank you.